Hello and welcome to KYC. I am Sharad Dubey and you are watching NDTV Profit. Let's start the show and I'll give you some hints about the company which will be coming today and KYC. The first hint, of course, it's a travel and tourism based company and it's an old company. Interestingly, the company's ambassador is Bollywood heartthrob Ranbir Kapoor. The last 6 months has been really strong. Almost stock is up 92% in the last 6 months. And you must be guessing which company is this. There is Ranbir Kapoor involved. There is must be travel. So we are coming very close to it. And life is a journey itself. So the company in focus is yatraonline.com. This is the company which we'll be talking about in KYC today. But the question remains is, why are we calling this company in KYC? A lot of retail investors know about it and institutional players also. So what's new in it that we are getting in KYC? The first question is the transition which is happening from the consumer to corporate business. That's what we look out for. The leadership change has also happened. And now what happens next for the management? That's what the important questions will be. Apart from that, the travel tourism trends, we'll discuss that in 2026. But remember, there is an angle of corporate bookings much more there because companies focusing, it's a shift from the retail bookings as well. Also, apart from this, we will be looking at the margin trend from the long-term perspective. How does the margin profile change of the company? And looking ahead, how much changes would be coming in the ROCE numbers as well. Will this be the growth levers or not? Also, apart from this, why we are calling the company, let's give in more details about this company. What is the total thing about the company? What are the key details you should know going ahead? And of course, the management will also be there. The company was established in 2006, has a strong track record of building a scalable and sustainable travel business, and they follow a multi-channel approach. It's a go-to-market strategy. Technical? Just let me explain you very simplified. It's online, offline, both it's there. The travel and the hospitality value chain, everything comes in for the company, and it's India's largest managed corporate travel services provider. When I talk about corporate, all your office bookings, corporates, they are there, mostly there. And largely they are catering to large and medium corporates. They have roughly 58,000 SME clients. And it's India's largest OTA platform, online travel agency. OTA, that's the overall full form, and it's a one-stop solution for leisure and travel needs. Almost, you could say, 81% of the total traffic has been driven by the direct and the organic channels as well. Let's look at the segments, how they're actually panning out. And largely, corporate and consumer, that has shifted to the corporate business. And the consumer business has been cut from has cut its total bookings from 55% to just 35%. So that is where the change is happening in the business model. And the recent management change was there, and I'd like to point out Dhruv Shringi. He resigned from the post of the CEO after 19 years. He's still appointed as the chairman of the board and continues to be the whole-time director. Interesting, the management change has happened, and Siddharth Gupta has been appointed as CA with effect from November 25 last year as well. So of course, there is management change happening, there is a business model change happening. So where does the company go now at inflection point? So we will be asking important statements on that. But let's just see in our KYC show why we have got these companies. We have spoken about it, but what are the ratings? What are the ratings we are looking at? That's also important. So we'll start with that, and around 8 parameters are there. The first one is the income statement. And let's just put this out, the revenue growth and EBITDA growth. Remember, the company is undergoing business model change as well, but it's been very decent. A good growth coming in the next 3 years. Over the last 3 years, a 59% CAGR growth and 139% CAGR growth. So net, it's looking strong. And of course, there was an inflection point in FY25 as well. Largely, the H1 numbers have also been strong, and that number has come in. And remember, the change in business model is there. So if you're comparing that, you should not compare apples to oranges now. And now the corporate margins, they are generally on the lower side. The play is on the volumes. In that, cross-selling is where the margins can go up when somebody is doing business in the corporate segment. So it's a strong thumbs up for the income statement. The second one is balance sheet. Let's get that in as well, and largely we see the balance sheet is stable. The H1 numbers you need to look at, there is a change of business model happening. The borrowings, it's largely now, it's a largely debt-free company. It's a decent balance sheet coming when I look at the reserves, overall numbers, and a good move. And it's still holding up. Cash balances are also there. That means the liquidity ratios are still showing strength. And remember, whenever you're in a B2B business, the payments do come in a bit early also. So that is a very important number to look at. But net, I'll still give a neutral rating for the balance sheet. Also, let's look at the cash flow segment, how the movements have happened, and H1 has seen a lumpiness in the cash flows. Just pull out the cash flow segment here and we'll understand what the important changes are happening, and then we see the operating cash flows. They are doing well in trade, and look at that. These are the numbers on your screen, the operating cash flows. A lot of changes happening here, but in H1 FY26, a 91 crore inflows coming in, and that's what I have liked about this. So net operating cash flows, I'll be giving this a strong thumbs up. But apart from these important rating parameters, we should know important rating parameters like the return ratios as well. The ROC in the ROE numbers. Generally, your expectations are you should get at least 15 to 18 odd % from these businesses, but that's not going to happen. The business model has changed. So what new thing which the company will do, that's what we will ask the management going ahead. Apart from that, largely it's a neutral rating coming ahead for this segment. But let's go to the shareholding part. Let's see what's there happening here. Promoters are holding up the stake properly, 64%, but my concerns do creep up, especially in the FIs and DIs. FIs, it's not so much holding, but DIs have been significantly reducing the stake, 24%, and then again 20%, and then 13%. So there's a gradual decline coming in. And the other hand, the public participation has started going up, and this is perhaps, of course, the stock also rising up a lot. So institutions cutting their stake, and then the public is, increasing the stake. So net, I will be giving this a neutral rating. So apart from shareholding, let's see the street cred. How much changes have happened here? Last 1 month, nothing has happened because the stock has rallied a lot. See, 6 months, the stock has doubled. And that is where the business change model has happened, and that's already factored in the stock. Last 1 year move, it's around 51 odd %. And since its IPO, of course, a lot of correction also had happened. So it was just a mere 15 odd %. So it is definitely a neutral rating when it comes to the stock reaction. Now let's go and see how the valuations come out with its peers. Remember, the company's business model is shifting from the retail to the corporate segment. So let's see how the valuations pan out, and I've taken 3 to 4 peers also in this segment. Yatra.com, we look at it, the valuations, the 12-month forward P ratio, that's coming in at 29 times. It's a bit decent. Of course, the highs which are there went up to almost 35 to 40, but the concerns are there with the peers. Ixigo is trading very expensive, 74 times, IRCTC 49 times, and Thomas Cook 19 odd times. So it seems fairly valued, but as compared to its other peers, it still is cheaper. So on the valuation front, in the current levels also, despite the rally which we saw in last 6 months, right now the stock has cooled off, and if the company delivers good numbers, maybe the valuations look very attractive right now. So for that, I will be giving this a strong thumbs up. Also, let's look at the outlook, how things pan out, and that's our last rating parameter for FY26. They're expecting a 20% revenue growth coming in. Remember, there is a change happening in the business also, and during these times, numbers can, move around and be volatile. Apart from the EBITDA growth, that's expected to be around 30% for FY26, and this is largely known in the public. There's a more focus happening on the corporate business versus the retail business. So we will be seeing the product mix shift as well, and this will of course impact the margins as well. But the thing which I'm really liking about the company is the cross-selling opportunities in the corporate space. Anything which can be measured, which can be quantified, it can be given a value. So we'll understand from the management, see what's actually going to be a key trigger for the company when it comes to the cross-selling space. But apart from the cross-selling opportunities and the outlook, which you gave a neutral rating, I would just like to revise the numbers which are there, and of course the numbers are really strong. Cash flows and income statement was something which was really appreciated by the company despite so much changes happening on the background, and most importantly the leadership change. So the new management will definitely have to do a very strong homework. Looking at the street cred and outlook, it's largely neutral. Valuations front, that is compelling. And because of that, I have given a strong thumbs up. But let's give the total KYC rating for Yatra Online, and that stands on the higher side of the average when we generally give the numbers, and that's around 5.5 out of 8. So that is something which we will be looking out for. But to give in more perspective, we have the management will be joining us to give us the entire perspective. And of course, today we will be joined by Dhruv Shringi. He's the MBA from NCAD and he's a qualified CA. But interestingly, he started Yatra with just 3-member team in the year 2006. So the journey is so small, but now he has made it so big. He's the co-founder and the executive chairman right now. And the transition which I was talking about, he recently resigned from the post of CEO after 19 years. Now, of course, there's a new management coming in and he is getting a role. But you could say that definitely, a lot of changes are happening. But to get the changes, the handover and the future, everything from Yatra, we are joined in by both Dhruv Shringi, co-founder and executive chairman at Yatra Online, and Siddharth Gupta, CEO, Yatra Online as well. Dhruv and Siddharth, a very warm welcome to you. It's looking like in the screen, split screen, it's looking like the future and the past, but I wouldn't say the past because past is still with the current. So I'll start with Dhruv. You yourself are, an industry legend as well. I would like to start with the transition phase, that handover which was there, and the markets really liked it, and there was a change in the business model. So first, your view, Dhruv, I need is how the changeover is happening and how the strategy changes now for the company.
Sure. So firstly, good morning to you and all your viewers. In terms of the change which you're referring to, the change in business actually got initiated almost about 3 years ago. As we were coming out of COVID, we realized that our corporate business was highly sticky, was growing rapidly, and we were able to build the right defensive modes for the corporate business. Keeping that in mind, we decided to double down on the corporate business, and that's the shift that you were articulating in your presentation earlier as well. So what you see right now is more of a continuation of that strategy of focusing on the corporate side of the business. Corporate side is a lot more stickier, has better operating margins, and we've seen that, over the course of the years, we are able to build a highly defensive business in this space. With Siddharth coming on board, the endeavor would be that firstly, Siddharth brings with him a great amount of experience in the B2B space. His experience should help us accelerate the growth on the corporate side now and take it to the next level. Within the corporate also, there are multiple then segmentation, which is there, right? We historically have been more focused on the large corporate customers. Siddharth will be able to expand that further into, mid-market and also the SME space. So the canvas for us expands pretty significantly with Siddharth coming on the board.
Now, of course, Siddharth, the question automatically comes to you. What's the new thing you bring to the table? And this entire corporate setup, how does this actually work? Because whenever we have actually judged a company, most of the times in the listed space, it has been consumer. How much different this business is? Explain us the payment cycles, the margin profiles, and what's the stickiness about?
So thank you so much, and just want to wish all of you a very good morning as well as a very happy new year. I wish on the two frames you had somebody who had less gray hair than Dhruv, but and the before and after news would have been even more sensational. But I think Dhruv is a legend, and a lot of respect in the industry for him. Again, coming back to your question, this transition from first of all, this is the strategy does not change. This transition is all about how do we execute more intensely on this strategic template that we've already set. And if you, if I need to elaborate on that, a lot in the travel management space kind of the attention goes towards the consumer space. But what people don't realize is that we are very uniquely present in this market where more than 50% of our revenue actually comes from the B2B space, which is the corporate space. And one thing that hugely differentiates and goes in our favor is that unlike the consumer space, which is more about deal and very less about loyalty, corporate is hugely sticky in its nature. So Yatra is the only talent, travel management company which has got a very sticky consumer base very good metrics on net dollar retention. So net dollar retention is a figure which which almost all analysts track, which is on how much business of the total pie that you get, which comes from your which is a repeat business for you. And I think on that parameter is where our intent to focus would be. Um, Again, as Dhruv mentioned, uh, our gross margins or our EBITDA numbers are far better than the consumer space in the B2E, and also the new addition, which is the rapidly growing MICE business that we have. So, the focus would be to focus on product and technology where we are able to automate more processes for our corporate customers. And then they come back to us, renew more business with us. They give us, additional processes that they want to automate on our platform. So we've recently launched an expense management solution which closes the loop on corporate travel. On top of it, they come back to us and they say, okay, why don't you manage my annual getaways that we do, the planning sessions or strategy sessions where we call all our senior management somewhere outside. That's the MICE part of the business, which again, on
Siddharth,
profitability
yeah,
metrics are better. So I think that would be the focus to start with.
yeah.
And we will continue to double down on that strategy. And then also, because that will bring
Yeah.
more
Siddharth, I just want to get you on this, the margins front. You spoke about a higher margins currently there. Just could you give us, because there's a lot of business model changes are happening and it's not fair to judge a company on the margins right now. But blended margins going forward, say 2 years or 3 years down the line, if I have to analyze the business, what range we can expect? And largely you're going to be a B2B player, 70 to 80 odd percent of maybe your revenues might be coming in. So give me a blended margin profile picture, what company will look like in the next 2 to 3 years. Range would do.
So, range would be very difficult to land right away because I think we are in the process of shifting from uh, being a heavier on the B2C front to a B2B leaning company. But for sure, going forward in the next 2 to 3 years, we'll maintain the same amount of, and a bit of margin improvement on where you see us today. The beauty of the B2E or the B2B space is that the demand doesn't cost the same amount that it costs in the B2C space. So hence the margins would keep improving. So for example, if you see it in 2025, about 60% of our EBITDA is coming from our B2B space. And that I think few percentage point would lean even further in the next year. So I think we will keep improving by few percentage point every quarter. And you should see that our EBITDA margins slightly moving and trending the way they are trending today.
That's an interesting
Maybe
take on that. Yeah, Dhruv, go ahead.
add a little bit more on that. So if you look at today, the key metric that we drive people to focus on is our EBITDA to gross margin, right? So revenue has its own accounting nuances, but gross margin is the true earnings of the company. So we focus on EBITDA to gross margin. Our EBITDA to gross margin has been trending around the 20% mark. And as Sid mentioned, almost 60% of our cost structure is fixed in nature. So as we keep adding good quality revenue, we will see operating leverage driving that 20% number upwards by at least, we think, 150, 200 basis points year over year. From an aspirational number that we have shared, externally earlier, our aspirational number would be to get to about a 30% margin from a EBITDA to gross margin ratio. And the key levers for that would be operating leverage and selling higher margin products like hotels, MICE, car rentals, etc.
Dhruv, it's an ecosystem which you are looking at. That's the corporate ecosystem, and a lot of cross-selling opportunities come in because you have just barely scratched the surface. If I'm looking at from a macro point of view, if had I been in your place, so a lot of things are happening, for cross-selling. So how does the opportunities come up for the company? Any kind of inorganic growth you are expecting? Because a huge world opens up in this corporate space.
So cross-selling is happening on two paths, right? One, it's about selling more products, be it products like, as I mentioned, hotels, MICE, car rental services to our existing corporate customers. The other is in terms of selling new technology solutions like expense management to our existing corporate customers. From an M&A point of view, the way we look at this is that M&A helps us expand the pie of corporate customers. So we typically, and if you look at our historical experience also, we've done a couple of such acquisitions in the past. We look at this as a way for us to get good quality customers. And then using our technology stack, we are able to improve the stickiness of those corporate customers. We are able to improve the corporate margin that we drive from those customers. That's the way we look at this. So it's going to be a combination of the two going forward as well in terms of both organic and inorganic growth. Organic growth will drive margin enhancement. Inorganic growth will help us also expand the base of customers that we have.
That's pretty interesting. Siddharth, I want to get you on the interesting travel trends which you're seeing. These are important travel and tourism trends which are coming up in 2026. The corporate setup also. There are, of course, the travel packages are there which you are already there in. But is there the group packages coming in? What are the important trends which you are picking up? It can be for consumers also as well as for corporates. Siddharth.
Yeah, so frankly, just to kind of summarize on how travel has moved. If you remember, till about last year, we were still struggling with getting to the pre-pandemic high, or the highs that the industry had seen, and we were still saying that okay, whatever is happening in the domestic or the international travel front, we are still below that number. But if you look at the 2025 numbers, we are from a domestic travel standpoint, we are already upwards of 20% on that growth already, the highs of 2019. And similarly, on the international front, there's an industry body report which has come out where we are about close to 10% higher than where we were on the high. So I think overall, whether it's domestic or international, the trends have changed. I think there's the demand which used to be more cyclical earlier. Now it's more of a structurally inbuilt demand of the country. I think overall our growth story and the travel and tourism story is now fairly strongly aligned together. So we expect that the market would keep growing. And within that space, frankly, there is religious travel as one thread where there is a huge travel that's happening across India. There are international religious circuits which are performing beautifully well. There is a Gen Z which has taken on travel as part and parcel of their life. So they are using a lot of LLM, coming up with newer destinations, and then we are responding to it with packages. A very interesting trend that has come up is milestones in people's life has become really important. That's where the group booking piece comes in. So we are fairly large on the corporate, which is the MICE business that you spoke about, where we pick up these large travels that corporates do across the year when they're planning for things or when they're reviewing things, or they're getting their suppliers and their ecosystem together. But more so now, our holiday packages are picking up as well. We have people celebrating various milestones of their life together. They come to us and they kind of lean on us to leverage the supply base that Yatra has to build and stitch great products for them. So I think overall, across various lines of businesses, we are firing all cylinders. Hopefully, we'll deliver a great growth and a great margin story for you across our consumer base.
Yeah, and see, Siddharth, you gave me the hint for the next question, and that's milestones. Dhruv has conquered a lot of milestones in his life, and going ahead, if somebody is listening to you from Gen Z point of view, as a person with just two people on board, they're 22-year-old listening, and now they want to get into the travel and tourism business, what advice you will give, Dhruv?
I think travel and tourism is a very, very dynamic industry. It's an industry where you have to firstly be passionate about the product because you yourself are a consumer. Like I love traveling. I've been, always at the forefront of trying to explore new destinations. So I feel this is something that has to come from the heart. And the good thing about the industry is that the industry is growing very rapidly. See, if you look at every data point which is coming out of research on India and the consumption story, for every $1 of incremental disposable income, 70 cents out of that, so 70% of every incremental disposable income is going between travel and dining out. So as a category, this is a category that is exploding.
Yes,
So if you
Dhruv. So this becomes pretty much interesting, Dhruv. We have a little bit of less time on us, but you have given us the entire view of the industry and what a newcomer should do if they want to come in the industry. Thank you very much, gentlemen, Dhruv and Siddharth, for your time at NDTV Profit. Best of luck and wish you a happy 2026. Well, this is the management of yatraonline.com. And that's all, folks, for KYC. Stay tuned to NDTV Profit.